Welcome, welcome, everyone. Welcome in. Everyone a chance to get connected. Hope you're having a good evening. Welcome in, everyone.
Hello.
Hi, Jean. Are you back home?
Not yet, haven't gone yet.
Oh, I thought you left already.
No, I'm going Friday.
Oh, good for you.
See you in December.
Yeah. I love your lifestyle. That's so fun.
Invest in real estate. That's the secret. Then your tenants will pay for your trips.
I love it. Well, I'm going to have you on the show next time. Come back in December. We'll talk about bringing you up to explain your strategies.
Start
Awesome.
young.
Yes.
I've been investing for more than 50 years.
Wow.
It's a good life.
Yeah.
Hey, there's a program on every morning at KDOW radio program with a guy who is, I sort of run my schedule around him. He talks about real estate and multifamily investing and single family too. He's really, really interesting. Do you know what I'm talking about?
Is it Tom Wilson?
No.
Oh,
He's out of, his name is, oh dear. I'll tell you in a minute.
okay.
But he's out of Texas.
Oh,
And he says it's not the money, it's the lifestyle. And
yes.
he's really, really interesting. So I always I plan on making breakfast, eating breakfast, ironing clothes, doing things that I have to do anyway. But I can schedule it to listen to him.
Well, if you think of his name, feel free to share it in the chat.
All right. It's on at 9 o'clock, Monday through Friday, 9 a.m.
Okay.
And it's on station KDOW, KDOW, and the numbers are 1220-1220. And that's a financial station.
I actually used to be a radio personality on that station.
You were?
I was.
Oh my gosh. And you don't listen to this guy every day?
Nope, I don't.
His name is Dale Wumsley.
Dale Wumsley. Okay, great.
He's really, really, really interesting. He lives in a 25,000 square foot house with a 12-car garage. And he has this enormous train set that he built up, and he has this fabulous house that he keeps telling you about, and it's kind of fun to listen to.
Awesome. Well, thank you for sharing. I'm going to go ahead and get started. Looks like we've got a good amount of people all in, and they've got audio hooked up. So welcome to SJREI for September. And we are where the deals happen, and you can ask us anything real estate. So just using our disclaimer, we are here for education. We make no endorsement, warranty, or guarantee of any type. We encourage you to do your own due diligence. Okay. Our mission is to provide education, networking, and inspiration that enables you to make wise and profitable investments. We all want the lifestyle that Jane has. So we are where the deals happen. 78% of our regular attendees have done business together. So this is where the action is. Coming up In September, the 22nd to the 24th, I am one of many speakers over 3 days at the $1 Million Meeting. So the $1 Million Meeting is in Dallas, September 22nd to the 24th. And they focus on talking about lead generation, business operations, building your influence and authority, raising private money, building your own team. If you're wondering if this particular seminar is for you, it is if you are doing deals and you're ready to go to that next level. If you're a giver and you're ready to learn in an interactive environment, because you'll have plenty of time to interact with at least 200 other investors that are like you. And if you understand the value in surrounding yourself with A players. They say it's not for you if you're not actively doing any real estate deals, you're not motivated for massive change, and you're not ready to roll up your sleeves and make a change in your life. Normally, the tickets for this event are $299, well, a little bit higher, but $299, $499, and $999. There are 46 seats left, and I have 10 prepaid tickets of the general admission that we can share with you. So I think Jeff is going to put in the chat how you can get your free ticket if you'd like to join me in Dallas. So what you need to do is copy and paste the looking forward to the $1 Million Meeting in your social media, along with the link that is linked to my name. Take a screenshot of that and send it to Anna at FlipNerd, and then confirm that you're actually able to join us in Dallas, and then watch your email, because the decisions on who gets to participate and get one of those free tickets will come to you in email. So Jeff, are you able to put that into the chat for everyone?
I did just now.
Okay, perfect. Wonderful. So as we talk about deals, we have another deal in our pipeline. We're looking for joint venture partners. This particular one came to me from a realtor friend. This house almost looks finished. When you look at it, it's beautiful. You'll see here, it's already been updated as far as pavers. The exterior has nice landscaping. The backyard is beautiful. Even some of the section 1 is done, but there's a couple glaring issues with this particular house, such as the kitchen. So the previous sellers did not want to put the money in. We were able to get it at a very decent price. And so with a light rehab, doing the kitchen and the 2 bathrooms, we'll be able to flip it back out onto the market in about 2 months. And we're looking for funding in the 200,000 range. We're looking at 100,000 minimum, so taking 2 people. The key is that this is something that needs to happen in short term. We'll be closing in 17 days. That's part of why our offer was accepted. So we would need to have that money in a IRA already. Okay, sounds good, Jane. We need to be able to get access to that money in short order. And we'll just go ahead and email Darby at support@sjrei.org, and we'll send you over the term sheet and you know how we'll split the profits. So thank you. All right, so tonight our featured speaker is Brian. Now, this gentleman has been doing real estate since 2008. Wholesaling, he went into some other things like land trades, private lending, and then he found notes. And notes really elevated him as an investor and deal maker because he became a deal architect. And so we have him here today. He's going to share with you some creative things. And please don't tell me creative financing doesn't work in the Bay Area. I'm here to tell you, like, our last 4 deals have been seller finance, creative finance, lease options, anything you want to say, retail. We have retail, we have commercial, and we have residential. And seller financing, creative financing, all this works in the Bay Area. So without any further ado, I'm going to turn this over to Brian, and we welcome you.
Awesome. Thanks so much. I really appreciate it. So let me do this. First things first, let's share my screen and just give me a confirmation there that you see it.
Got it.
Sweet. Awesome. So here's kind of what's really super cool. I'm very excited about this specifically today is I have been trying to build what I think would be the most valuable content specifically for this group over the last week or so. And I really feel like I've tried to pull a couple of pieces of information that are either just super relevant, you need to know. Maybe they address the biggest pain point in the marketplace today, which would be what? Like finding a solid deal. Maybe it's raising capital. We'll talk about a whole bunch of different things, but really I want to talk about those things. And I really want to spend some time talking about what's coming in the marketplace. What is the next big move, right? A lot of times we're looking at it through this standpoint of it's a market cycle. So a big move being we're going to go up from here, we're going to go down from here. I can get a little bit more granular than that to hopefully maybe give you a little bit of clue on kind of some of the data that we're seeing, as well as some of the stuff you should be aware of. So saying all that, let me kind of get into it. And I've added so much content. I don't exactly know how much I'm going to get through, but I'm going to try to get as much as I can through the internet here to your homes. And I'll stick around for Q&A as long as you guys need me. So kind of like Lori said, I did actually get into real estate in 2008, but I actually didn't go full time until 2014, right? That's really where I was trying to juggle the real estate world, which is, all I knew about was rental properties, just buy and hold and that's it, right? Well, in 2014, I went into work one day and they're like, sorry, man, we're letting you go. And I was just really shook by that. I didn't anticipate, nobody anticipates going in and being fired necessarily, right? And so for me, it was very much I'm not really sure what to do next. So I got to go home and have that super fun conversation with my wife. I was the only income earner in my family. My wife was pregnant. I had a son. I needed to do something. And I happened to get the phone call that says, hey, there's this thing called wholesaling and you could buy and sell houses with none of your own money. Now, to me, with no money, this sounded like the most brilliant idea I've ever heard. So it was really kind of the interesting thing that just I happened to be at the right place at the right time. The timing in the market was perfect. Really for those of you who've been in the market a long time, in the real estate game a long time, you've seen parts of the market cycle where it's just perfect to be a wholesaler. It's just perfect to do this strategy or this strategy. And that was kind of my journey, right? Like Lori said, I kind of dabbled in all these other things and ultimately kind of found my way to notes, not necessarily really because it's like, oh, this will allow me to do X, Y, Z, but because it allowed me to really see that I can do more deals, I can make more money, but also it really helps to increase my passive income without having to have lots of capital, which was my problem early on. So in 2014, when I went full time, I was just wholesaling and then I eventually started flipping. And in 2016, I met the man you see on the screen there, Eddie Speed. Now, for those of you who don't know Eddie Speed, let me make it super easy for you. Here's the two things you got to know. The man's been in business. He's the founder of Note School, and he has been in business for 40 years. And he's now done over 50,000 transactions himself. Now, that in itself really tells you the guy probably knows a thing or two that maybe I don't know. At least that's what I came to figure out, right? And so he told me about all this stuff actually in 2016. And in 2016, business was a booming, right? The market was just going like this. What could possibly go wrong? I just couldn't find enough houses, basically. And he really encouraged me to entertain the idea of creative financing and notes because his presentation at that time was just incredible. It was at my local REIA in the Dallas, Texas area. And I really just thought, this is cool, but this is for later. This is about building wealth. And what I didn't pay attention to was clearly a big section of his presentation where he talks about, I never had to give up my income today. So I tell you this whole story really to help you better understand kind of where I'm coming from, because after trying all these different strategies, I really started to find some things that work regardless of the market conditions, as well as they're going to make me better at whatever strategy I'm trying to accomplish. And this is really what Eddie calls a deal architect. So a deal architect is simply just a specialized real estate investor, right? Somebody who wants more from their marketing dollars, more from their deal flow. Currently, maybe they want to do more deals, or more from just, I did a deal, I made X number of dollars. Like if I wholesale the house, I would make money, but I would be giving up the cash flow. What if I could make the money today, but also, partake in the cash flow, right? And this is really where the world of creative financing came in. And I say that as a broad term because creative financing is pretty broad. Some of you have heard of it, some of you have tried it, and some of you love it and some of you hate it, right? But the reality is this, it's this extremely broad term. And really when he encouraged me to do creative financing, he basically said, look, this can radically change your business. And I was thinking, look, man, I've been in this for 2 years. That was mistake number one that I said out loud. And then I also said, like, things are doing better than what we anticipated. I expected this many deals, we're doing this many deals. So I didn't have a problem in my business in my mind, right? Really being naive, not knowing what I didn't know. And over time, right? That was in 2016. It took me till 2018 to really better understand how important this is and really where this fits in. And that was only because the market shifted in Dallas in 2018. That's when we started to see a massive influx of competition, sellers wanting higher prices. And I really struggled to get near as many deals done. Well, I remembered a lot of these conversations. And I tell you all that because these are kind of combined worlds, this creative financing world and this note world. And I want to show you the bigger picture so that you could be doing more and more. And I'm going to start really by kind of going through really what I think is probably the most important thing to say at the beginning, because I'm going to say note, like, I don't know, 150 times. And so just to get everybody on the same page and not leave anybody behind, a note is simply just a promise to pay. Somebody owes somebody else something, right? Somebody owes somebody money for X, Y, Z. So if you write a check for $1,000, hey, you owe that person money. And if you don't have that ability to pay, that money's not in that account, well, then you're defaulting on that, right? Obviously, if you go read your money, which most people don't, it is a Federal Reserve note. It is simply a promise of value. And when we talk about a car note or a house note, that's a lot more similar to what we're going to be talking about tonight, which is there's a collateral element, right? If you don't make that car note payment, they come and repo that car in the middle of the night. They come and foreclose on you if you don't pay your mortgage. Obviously not in the last year and a half. We all understand this, but who knew that was a thing? So I tell you all of this to tell you that this is kind of the direction that we're going. And I start there because I really want to kind of just take a step back and show you the 30,000 foot view so you can better understand what a man with 40 years of business experience and buying notes, and he's done over 50,000 deals. Let me kind of show you his view, and then we're kind of going to drill down into some things that we can actually take a look at and really take action on. So this is really what we call the 6 biggest niches in the note business. And really, it starts from the life cycle of the deal, the beginning of the life cycle, just meaning that buying properties with creative financing is when you're buying a house and the seller provides all the financing or provides financing in some way or another. You don't go to a bank, you don't go to a hard money lender, you're using the seller as your lender, right? And really, what benefit is this? Well, obviously you can get additional financing, but what most people don't realize is the reason creative financing became so popular decades ago was because you were able to get terms that a bank would never give you. And that became very attractive to the investor because now all of a sudden the options are pretty limitless, right? And this was really powerful because this helps you with scale. This also helps you if you don't have money, et cetera, et cetera. And so let's just assume for a second, you go out, you buy a house and the seller provides the financing. What can you do? Well, you could wholesale that. You could package it up and wholesale it to somebody else. You could rent it out. You could put it in there. You could fix and flip it. You could do any strategy that you're already familiar with solely because now you have a house and the financing all bundled up together, right? Now, one of the things I want to talk about today is really another exit strategy. For me, this is what I was doing. I was trying to buy houses with creative financing early on, and then I was packaging them up and reselling them with a wholesale strategy, right? Or maybe I would put a tenant in there. But ultimately what I found out is I could actually turn around with the seller providing the financing to me. I could turn around, I could resell that same asset, and I could be the bank to someone else. And this other party, our new buyer, would owe me a note, right? There was a promise to pay coming this direction. And of course, I was responsible to make my payments, right? And why was this such a revolutionary concept for me? Well, for me personally, the concept of tenants never really went well. I didn't do great with my rental properties. In fact, I even started a property management company because I was that convinced, surely I could do this better. Full disclosure, I cannot do it better. It took me about 6 months to figure this out. And I actually had to beg a buddy of mine to take the entire business away. I said, you can literally just have all of it. It's all yours. I can't handle it. This isn't for me. I just want to be too passive, I guess is what it is. And so really when I entertained this new idea of, well, now there's the borrower who owes me money, I'm the bank. Well, they're fixing up the house and they're paying for repairs. And who's more likely to pay, the tenant or the borrower who just gave me $25,000 down payment or $50,000 down payment or whatever, right? And really, this is a big conversation we're going to get into today, solely because these two little triangles, these niches, there's such a different approach you could be taking to acquire and exit more deals. And for those who don't know, Eddie Speed actually, if you're familiar with the Homevestors franchises, right? The Ugly Homes people, he was good friends with the D'Angelos in the early 90s. And he actually developed all of the seller financing curriculum for all of Homevestors. And we actually still have about a dozen or so really franchisees come through Note School to kind of learn the rest of what you're going to be exposed to tonight. So I tell you this part to show you this is how a note is created, right? You're acquiring a property or you have a property already, but you're going to find another buyer and you're going to have them owe you something. You're going to generate simply a note. Now that you understand this concept, there is a monster tax advantage we're going to get into, and you're going to see where this little, very, very little used strategy comes into place in today's marketplace. But specifically for creating our own note, you're now in the note business, then what can you do? And this is when I get to kind of pull back the curtain and say, now there's a lot more opportunity to show you there's a whole other world on the other side of this, right? Once a note is created, notes are actually bought and sold at a discount. And most people don't realize this. And this allows me to simply buy it at a discount and wholesale it or flip it to somebody else, right? So maybe you're brand new to real estate and wholesaling is a strategy and you're struggling or you're wanting to do more wholesaling. Well, you could wholesale houses and then you could also wholesale the paper side of real estate, which would be the note business. The cool part about wholesaling notes is half of the equation is already done for you. I could show you where the inventory is, or I could show you who the buyers are, right? And really you just got to find the other ones. You just can't put these two together. But this is really kind of a convenient part of the business for newer people. This is how Eddie Speed started in 1980. He was wholesaling notes at 20 years old to generate cash, right? It allowed him to make some fee income right away. And he just goes on his merry way, right? And then there's the people who are here who are like, Brian, again, you're asking me to work, not super into the active thing, really interested in finding ways to be passive. That kind of allows me to go into this whole conversation of performing loans, performing notes. And instead of buying a rental property and being exposed to the newness of, maybe you don't know if your tenant's going to pay on time, you don't know what's going to break, whatever those variables are that might increase your risk. Really with performing loans, you're looking at it through the standpoint of, hey, can I keep my rate of return that I would normally get, right? Can I keep the collateral being the house? I want the house to be what protects me. But more importantly, can I see that they've been paying for 6 years and they put a big down payment down? Because if they put a big down payment down and they've been paying straight for 6 years, probably a lot lower risk profile, right? And that is really where this becomes of interest. Eddie Speed will tell you, the longer someone's in real estate, the more attractive notes become, because you don't have to give up the good parts. You just want to lower your risk, right? And there's a leveraging strategy I'll show you with this that is the best wealth building tool that I've ever seen. And if you stay to the end, not only will I show you this, in fact, Lori, if you stay to the end, Lori is going to be giving away, I don't think she even mentioned it, she's going to be giving away her latest book literally for free, just for staying to the end. That's one reason, but two reasons to stay till the end is I really want to go through that strategy. And then really this next niche is this burnout landlord capital conversation. Now, what in the world is this? Well, I told you I got reintroduced to Eddie Speed in 2018. I said, fine, you clearly know things I don't know. No, I'll stop being stubborn, and now it's time to listen. And it really did radically change my business. And in 2020, he asked me to be on his teaching team, really to come in January to talk about this conversation of a burnout landlord, because there was data that came out that says between 2010 and 2020, there was an additional 18 million real estate investors entering the space. So you've got your normal curve of people joining the space. Now there's this giant leap forward. And where are all these extra 18 million people coming from? Well, it actually came from 4 letters, if you want to know the truth. It's HGTV. That's right. So you got your Chip and Joanna Gaines, you got your Vanilla Ice was flipping houses, you got, I don't know, Property Brothers, whoever you were watching on HGTV, you fell in love with them. And that's what they were counting on, right? No, I'm just kidding. But the point was that families all across the country, including myself, right, during this time period was like, man, it seems like there's money to be made. And maybe you like turn to your spouse on the couch and you're like, you see the big dollars at the end of the episode and you're like, how hard could it be, right? Maybe we should give it a shot. And so really this conversation came out of this set of data where you see all these new people entering into the space. And we even give them the benefit of the doubt. We say, hey, they met Lori Graymont and they came out and they got a little bit of education. They even went out and they bought at least from a wholesaler rather than finding their own deal. At least they bought it at some sort of a discount. So there was some sort of margin in there. But for those of you who understand flipping houses well, especially if you've ever done it at scale, you understand it's not as much about the houses as it is about managing contractors, budgets, and timelines. And not mastering these three things magically changes your renovation budget from $35,000 to $45,000 to, you get the point, right? We've all heard the horror stories. And so what we saw is this massive trend of people jumping into the space, trying one strategy. And when they either were breaking even, losing money, or they weren't going to make what they wanted, there was this conversion of, okay, instead of trying to hurry up and, just take a loss and then let's get back into it and turn these deals and try to grow this thing, they said, all right, I'm just going to put a tenant in here. And there was this, kind of this light bulb moment of what they thought was going to happen was, the tenant will always pay. There's no such thing as an eviction moratorium. And in 30 years, this will be the best investment ever. And the reality is they're right. In 30 years, a rental property will have treated you so nice. Someone early on just mentioned that about, when you buy rental properties that long ago, it just, it makes it a little easier. But for those of you who don't know about rental properties, and really for anybody who's ever bought a rental property and held it for a long time, that it's not about 30 years. It's really about those first 1 to 5 years, right? Where that rent hasn't increased, right? To manage any sort of expenses. You can't exactly go and cash out and pull the capital back out. You're still really trying to nail down the right type of tenant and the turnover. The bottom line is this group of people right here found out the hard way. There's the good part of real estate, the cash flow, the rate of return, the protected by real estate, all this kind of stuff that they like, whatever that was. And then there's the part that they're like, look, I'm willing to put up with this in order to get this. And that's great. There's nothing wrong with rental property. I'm not going to try to talk you out of it. What I'm saying is that this group of people specifically, what was most painful to them is they wanted the good, but the bad was, yes, tenants sometimes don't pay. A pandemic magically causes all kinds of problems, as well as you're in a position to where you're putting more like that. The person who was flipping that house, guess what? That air conditioner that they fixed instead of replaced, remember, they were just going to flip it. It was somebody else's problem. Well, 3 years later, guess whose problem it is? It's theirs. And so now they're putting more money back into a property that has the same cash flow. And what does that do to the return on investment? It drives it down. And that creates a massive pain for this type of person. So really what we saw here is these are not professional real estate investors. These are just your mom and pop. I got my W-2 job. I make a good income. I'm just trying to get in on this real estate craze that everybody's doing. Right? There's 18 million of them. And so when we look at this group of data, really what we see is that the good part is great, but the bad part is like, oh, this is becoming frustrating. And so instead of scaling and growing and building a portfolio, we see a very high number of them only bought 1 or 2 or 3, right? Really no more than 5 properties in the last 10 years. They just stopped buying them. Why? Because this bad part became a little too much. They didn't quite make it worth it. And so they have all this extra capital that they could be deploying in real estate and they're choosing not to. So why do I have this long-winded story about burnout landlords? A couple reasons. This avatar, as we call them, this type of investor is really the number one person we're targeting right now for a lot of things. Number one, I could go to this burnout landlord and say, hey, I get it. You don't like this piece. You really like the cash flow, you like the rate of return, you like the asset, whatever it is, but you don't like the bad. And I'll just tell you what my little pitch is. Basically, this is what it is. I can go to any one of these people with high probability and say, look, I understand this. And if I could show you a way to where you could keep all of the good, I could show you how to keep your cash flow, maybe even increase it, keep your rate of return and possibly even increase it, keep the fact that it's attached to real estate, all the good stuff. but I could take away the bad. You don't have tenants, you don't have toilets, you don't have turnover. You'll never put any more money back into this asset that's going to lower your return. And if I could show you a way where you could keep the good and I'll take away the bad, would you be open to a conversation of really what that might possibly be able to look like, right? And it really becomes a lot of different directions depending on what they want to do. But the number one right now is, well, why don't I just buy your rental properties, right? The market's been going like this. A great way to lower your risk is exit at the top of the market. If you think now's the top, that's one thing. But really, we can eliminate a lot of the headaches. You'll be the bank for me. And I don't want your tenants, but I can solve your tenant problem. And then I work with a set of buyers that we call penalty box buyers. And they're really the perfect penalty box buyer who's going to give me a bunch of money down to protect both of us, as well as I'm going to work with them to help them eventually refinance and get out of this loan. Now, what does that do for you? That allows you to get a very specific cash flow, a very specific rate of return, and it'll never change. Why? Because I'm going to pay it and I've got cash flow coming in from this person and they're going to be heavily incentivized to do that. That's just one direction I could go. And I'm going to show you a different angle here in a second that really works well right now. And then the other side of that is once they understand what it looks like to be the bank, once they truly understand what passive real estate investing looks like, now all of a sudden they're really interested in working with you in other ways. And in fact, some of them aren't going to sell your rental properties. They just want to learn how they can be the bank for other things because you're positioning things, as you'll learn in a minute, at a very low risk profile. And so they want the upside, but they want low risk. And normally you can't get low risk and high return, right? And so we really are able to position this. And I've seen burnout landlords become marketing partners for wholesalers. I've seen them be lenders for fix and flip guys, build rental portfolios. The bottom line is this avatar right here, like never before, is willing to loan long-term money, meaning like over 10 years, but also at low interest, like 5 to 7%. Now, I'm a guy who scaled the fix and flip business, and I'm borrowing money between 8 and 12% short term. So when I found out I could borrow money long term at 5 and 6 and 7%, this became a super interesting conversation for me. And it really obviously shifted my business solely because guess what? I'm borrowing a lot cheaper money now, right? And so this is really where I go to fund the most of my note business as well. But I tell you all these things so that I can eventually drop this concept on you of the non-performing loan space or buying defaulted loans. And this niche is something that's very unique in the fact that it's a part of the market cycle that only exists for a season. We know that it's a market cycle, right? And so we've been doing this for a decade. Are we probably going to be doing this another decade? Probably not, right? And so when things start to roll over, there's a section of that time that really allows non-performing notes to thrive. And non-performing notes is bad debt. These are people who are not paying their mortgages. Why in the world would I want to buy that? Well, instead of fixing and flipping a house, you're essentially fixing and flipping the paper side of real estate. And you're going to see two things. One, you can buy things for very, very inexpensively, so you can make a lot of money. Just like if you were to buy a flip really cheap, you'd make a lot of money. But two is there's not a cheaper way to get into an asset of any kind. So if you want to own rental properties, this is going to be an avenue for you. If you want to own whatever, if you want to fix and flip houses, wholesale, there's not a cheaper way to get into this. And you'll see what I'm talking about here in a minute. So now that I've kind of like spent some time on that, I really want to take some time and dig into some of these concepts while we still have time. So you've got your traditional transaction. You got a buyer, a seller, a house, and a bank, right? And your seller is going to simply sell the property and your buyer is going to have to fund it in some form or fashion. Traditionally, we see you're going to go out and get a note. A lot of you landlords, this is what you do. Hey, I'm going to go get a mortgage from the bank. I could get really low interest rate right now. It's incredible. Borrow all the money you can if you're into leveraging your properties. But there's also a ton of people in our country who can't get mortgages right now. What are you supposed to do, right? Well, I have a strong argument for really both of those people. The person who can get mortgages, how many mortgages can you get? Because in my experience, I mortgaged out. They only give me X number of mortgages on my social security number. And then they're like, well, does your wife have income? And can we play this weird game? And then you finally have to say, all right, well, how do I move to a commercial product to where I can own all these properties on one loan? And then we start the whole process over again. And so you end up hitting these bottlenecks even when you can get a mortgage. But for those of you who can't, how are you supposed to build this portfolio? And I would argue that really for both parties, what if the seller was to become the bank? And why would they do that? Well, first of all, if you can't get a mortgage or you can't, in both instances, I can always get better terms with a seller than I can get from a bank, right? And that's a pretty big advantage. And we'll kind of talk about that. But really the other reason is the psychological side. Why would a seller ever consider, why would they do that? Why don't they just list it? Well, there's a couple of reasons. The number two reason, like the top two reasons they do it is they're going to get something that no one else is willing to give them. And I'll show you a good example in California of this. Number two is they're protected by that asset they're familiar with. So you're not asking them to say, hey, you loan me money, I'll give you a Beanie Baby collection from the 90s that's worth a fortune, or I'll give you a bunch of autographed baseball cards and you're just gonna have to trust me, it's worth a lot. You're saying, look, worst case scenario, I'm gonna make a bunch of payments. If I get hit by a bus, you're back to where you started. You still have a house that's worth probably more than you are sitting at now. And you've also gotten money from me. So the risk level mentally starts to drop because they don't have to be like, well, what's protecting me and how would I sell that and how long would it take me to sell it to get my money? And you're not making them jump through hoops. And really for today's purposes, here's what you need to understand. The most motivated home seller today by far is this hobbyist landlord, this burnout landlord, this person who is not somebody who is buying 10 houses a year, 10 rentals or properties a year. They're not a full-time real estate investor. Again, this is not that type of person. And to give you a little bit of information that we pulled, these small-time landlords, so 16.9 million properties is really what they own, right? 72% of these rental properties are 1 to 4 families. So almost 3/4 of this is single-family residential properties, right? A lot of what we invest in, right? Over 75% of our burnout, our hobbyist landlord, right? 75%, they self-manage their property, which means they're closer to the pain. Now, this is what you got to catch. Okay. And this is something that Eddie Speed pointed out to me. And some of these little things that really shaped my thinking that really helped grow my business. Our job as real estate investors is not to buy assets. And this is where you think I'm crazy, but listen, our job is to bring creative solutions to complicated problems. And if I bring a creative solution to whatever their problem is, maybe I bring cash and I close in 7 days because they're in pre-foreclosure and I could pay off what they owe and they can move on to the next chapter of their life. We all understand that. Well, what if they owe more than it's worth, which isn't a big problem now, but what if they want some crazy high price? I have to come up with some creative solution to solve whatever their pain and their problem is. And we're going to talk about that. During an eviction moratorium, when you can't evict your tenant, is there a point to where some pain might cause this complicated problem to be growing? Yeah, so I got to figure out how am I going to bring some creative solutions to that problem, right? Over 50% of these hobbyist landlords, they don't have a mortgage. So this is also, it's like a pro and con, depends on which side of the coin you're arguing, right? They got plenty of equity in these property, which helps protect them, but they're also not getting a rate of return. The other half, obviously, is not getting a rate of return, and they're worried that they can't pay their mortgage or whatever, right? We all understand this. And so really for today's purposes, I want you to better understand a different way to approach these deals, whether you're trying to expand your current creative financing operation, whether you're brand new to current or creative financing. And really, once I explain this is a way to not just acquire more assets, but then I'm going to show you how this relates to the note business, right? And we're going to use a little known tax strategy that really allows the seller to get literally everything they want. In fact, the majority of the time in the last couple of months anyway, that I've talked to somebody, they're not anticipating that I'm going to offer this. It really helps solidify the deal. And we're going to talk about what their pain, because their true pain is the unspoken pain. And this is where a lot of people may not believe this. But according to a super recent Forbes article, 8 million of these tenants, right? 8 million of them own, or these tenants owe the small-time landlords $20 billion in rent. It's actually 8.8 million tenants owe over $20 billion in back rent payments. So there's clearly some level of pain there. How about addressing that? Well, I'm going to talk about the real pain in the market today. See, it's not, Mr. Seller, you can't get your price, your house is, you understand market conditions, I got to buy it at a discount. That's not what we're talking about anymore. Okay. This is your traditional asset in America over the last couple of years, anywhere in the country. You bought a rental property back in 2014. Awesome. You bought it for 100 grand. Well, today it's worth $250,000. So you kind of want to sell it and capture that, right? Here's what sellers aren't saying to you. But if you'll start bringing it up, you're going to be amazed how much this bothers them. If they sold this rental property, remember, they're just the hobbyist landlord. So they kind of bought this thing years ago, and they really are looking at it through the lens of, oh, let's keep going, but the market's going so crazy that maybe it's the right time to sell. But if I sell, guess what? There's $150,000 that I'm going to gain, and I get to keep all of that, right? Or do I? Our good friends, the IRS, they love to play this game of, well, this is perfect. Capital gains, let's stick that on there. Let's throw a little tax on there and shake things up. You can give me a cut for participating in this fun real estate game. And so now here you are saying, Mr. Seller, I can give you this price. And they're sitting here thinking, look, I don't want to give the government 45 grand right now. This is not super interesting. And so because they're not saying that out loud, here's really how you can frame it to, one, really eliminate a lot of competition, two, get the conversation going, because we all know if you can get the seller talking about what's most important to them, your chances of getting that deal done skyrocket. But really, this is going to help the seller. And that's, in my opinion, what our role is. We have a specialized knowledge. And if you don't, that's why you're here, right? But with this knowledge, I have this obligation to, yes, turn a profit, provide for my family, provide for my staff, my company, whatever, of course, but also contribute to either my community or whoever. I can find a way to make plenty of money and help a lot of people. And we're going to do it through this lens of something that I'm going to refer to as a tax strategy. But please understand, nothing I'm actually going to say today is tax advice, accounting advice, financial advice, much like Lori said at the beginning. Please understand that's not what I'm trying to do. I'm just going to call it a tax strategy so I don't have to explain it every single time, okay? And really, this is what people are doing wrong right now. If you're somebody who's really trying to thrive with seller financing and creative financing right now, you're winning. Like right now, creative financing is really, really, really great in times like this. But you're really struggling to get sellers sometimes when it seems like, man, I'm so close. I'm struggling to get sellers to convert. And why is that? Because of the unspoken pain. And instead of offering a, hey, I could give you this price that you want, I can give you a down payment that you want, whatever it is, you just seller finance. Instead of doing that, I've always taught like, well, there's this logical, rational approach to use math to show the seller, hey, let me show you why this is in your best interest. And that's worked for the last several years. But right now, what I'm finding converts better is, Mr. Seller, I'm not going to offer you seller financing approach. I'm going to offer you a tax strategy approach, and watch kind of how I do this. And I don't have to be a tax expert. In fact, that's the best part about this is I'm the guide in this transaction. So I say, Mr. Seller, I'm going to point you into things maybe you should go look into. And if you think I'm wrong, don't do the deal. But the IRS has been doing this for decades and decades, and as many people don't do it. And so if you'll embrace this concept, you're actually going to get to keep a lot of this money. So what do I mean by this? I mean that, Mr. Seller, today, I give you this price that you want, we've agreed upon. You absolutely can get this money, but you got to pay tax on $150,000. Instead of doing that, I want to address a couple concerns that you have, some of which you're not even telling me, and some of which you may not even know are important to you. So let's put it really all on the table, and then we can talk about making a decision. What if I could take that $150,000 you owe, and instead of you paying taxes on it this year, we literally lay it on its side, right? And we really take that $150,000 and we spread it out over, say, 15 years in this example. And again, just a random example. But in this case, this would allow me to say, great, you're going to get $10,000 every year for 15 years, which means now it's the same percentage tax burden you have, but it's on $10,000 each year. Would you rather pay $45,000 this year, or, say $3,000 over, the next 15 years? We can all do that math, right? The thing you have to help the seller understand is every asset has different chunks that have different tax consequences and components, right? So obviously there's a part of the house that's most taxable, right? And then you've got some parts that because of some write-offs and some other things, yeah, they're going to be taxable. And then you've got the part of the house that is not taxable at all, right? Think of like the cost basis. If you bought it for $100,000 and now it's worth $250,000, you're not paying tax on any of this $100,000, right? And so really what we want to do is we want to help the seller understand this and say, Mr. Seller, look, Instead of paying the $150,000 today, taxes on that, we're going to put it on its side. But what we're going to do is we're going to position this to better understand what you need, because a lot of people don't like taking their money over time. Yeah, that's right. I tell a seller that a lot of people don't like seller financing. Why would I do that? Because most people don't like doing that because they have immediate cash needs. I need money today. And it might be 10 grand, it might be 50 grand, it might be 80 or whatever the magic number is. But I say, Mr. Seller, what if I could do this? What if I could show you not only how to take the tax burden that you have and spread it out, but I can actually take a part of money and give it to you tax-free today, right? And this would be the part that would be, the no tax part of the house. And then what we're going to do is then we're going to take the tax burden that is kind of like not as taxed, and we're going to pay that next. And then what are we going to do? Oh, then we're going to take that most tax portion and we're going to spread that out as far as we possibly can. Now, how can we do all this? Well, this is what the IRS calls installment sales, right? Again, they've been doing it a long time. Eddie's been doing it since the 80s and has a ridiculous amount of experience doing it. The difference is nothing's changed in the actual deal structure. What clicked in Eddie's head for a market condition like this is, why don't you just present it to the seller like this? Let me give you an interesting example, and then I'll show you a real case study. What if I could tell the seller, hey, what are your immediate cash needs? Like, what kind of money? Like, you don't need $150,000 in your pocket or $250,000 in your pocket today, do you? No, you don't. Okay, so what do you need today? What kind of immediate cash needs do you need over the next 30, 60, 96 months, whatever the time frame is? And if we can come up with that amount of money, what if I could give that to you? And what if I could give that to you tax-free? Now, all of a sudden, now you got walk-in money that's tax-free, and we're continuing the conversation down the road, right? This is what's so attractive. Give them a price they want, show them how they can really defer their taxes, and give them a chunk of money today that they don't have to pay taxes on. Now, some of you are already panicking because you're like, oh, Brian, let's not talk about big down payments. I'm going to show you why a big down payment is irrelevant in today's marketplace. And I'm even going to show you that even if the seller wants a big down payment, why it doesn't cost you anything. You ready for this? So let me introduce Seth to you, because Seth is a student out of California, and I specifically chose Seth as the example because for whatever reason, some people believe, hey, you can't do creative financing deals in California, or you can't do certain note deals in California. Look, I don't know what you heard, man, but I can tell you that Eddie Speed, who's done 50,000 deals in all 50 states, I mean, there might be some certain regulation for doing certain things certain ways, but I'm telling you that really there's nothing here that's going to cause you enough headache. The only difference is the way you did creative financing in the 90s, you're right. You cannot do it in California the same way today. But guess what? In today's marketplace, the same way you do creative financing in California is how I did it in Texas. Now I live in Colorado. It's how I do it in Colorado. It's all because of Dodd-Frank. And so we're going to get into that. But the bottom line is, with Seth, he's your traditional, he's your typical full-time investor, right? He's trying to buy houses. He's really coming up in the last couple of years. He's only been a note school student for about 3 years now, almost 3 years. And he's really struggling, obviously, with sellers. I'm sure you guys, you can't relate to people in the Bay Area wanting some really high price, can you? That's probably not a thing, right? Right? Obviously it is. Also competition. I just told you 18 million people magically appeared into our space. 18 million uneducated people traditionally, or at least I'll say unexperienced, right? And so it takes a year or two for them to gain that experience. And so with that, now you got competition, okay? And so he tried the two models I see more common than anything else, what I call the Walmart model, where you basically tell the seller, hey, I'll give you $1,000 over any written offer that you have. And he's also tried the, now that I know my marketing is working, I'm just going to double down. I'm going to take the risk on myself. But for any of you who have ever really tried to scale marketing quickly, you know how fast you can run out of money, right? Especially as the market shifts on you. And so he actually was a part of a mastermind where somebody said, hey, you should really consider talking to Eddie Speed. I think he can solve some of these issues. And that's really when he got involved with Note School and truly became a deal architect. And so let me kind of really walk you through this, because he went from your average Joe investor buying enough and selling enough houses to provide for his family to where now he's what we call a real estate ninja. He's a guy who buys over 100 houses a year consistently for the past 2-3 years. The guy's just crushing it. And I'm not saying everybody wants to be a ninja. Not everybody wants to go out and buy 100 assets every year. The point is that he's going to do it in a very unique way to where if you went and talked to 100 sellers, you would want to convert as many of those as you possibly could, even if you're only trying to do 10 deals a year, right? So let's take a look at this asset. And I think this is a fascinating one because I didn't want to choose one that was going to be like, oh, look at this. It's a really nice, a suburban home that's beautiful and it's a great neighborhood and great schools. This is a great asset. And there's a ton of buyers who would want something like this. You got land, you got extra buildings out there. You've got the mother-in-law suite. And the seller of this was in their 70s. They were moving from California to Arizona. They didn't want to be an owner anymore, right? They don't want to rent it from afar. And they just said, hey, I want to sell this thing. And it's a free and clear house, right? Like I told you, 50% of these landlords, they don't know mortgages. And so now we're in a spot to where really what's the story behind this? Well, all of us who've been making offers and talking to sellers, before you ever run an appointment, there's a ballpark price you want to be at, right? You would never go if you didn't. And tell me if you can relate to this. Believe it or not, is stuck on price. Can you believe that? They're just so hung up. So while Seth would ideally like to be around 375, that seller has to have 450. And so Seth doesn't panic. He immediately goes into creative finance mode, right? Deal architect mode. And he changes the conversation. He uses logic, reason, and math to explain to the seller, hey, I think if we did it this way, you can get everything that you want. And it would probably be the most beneficial way to do it for you. And don't worry about me, I'll make plenty of them. So Seth says, here's the deal. We're too far apart from my cash price. I want to give you like $375,000 cash. Seller says no, right? And if you're a smart investor these days, you're asking questions like, well, why don't you list it? Why don't you XYZ, right? The reason you're asking, trust me, they've thought about it, right? Some people don't ask because they're afraid people won't, they'll be like, oh yeah, why don't I list it? I've never thought about that. Instead, what they're doing is they're going to tell you every reason why your solution is going to work. Like in this case, he was like, I'm not paying real estate commissions. I need to net 450. All right, man, however you got to that number, it doesn't matter, right? The bottom line is, all right, I think I found a way to give you that. But really, as we go through the dialogue, what's your immediate cash needs? And in this case, it was $50,000, right? Now, it really doesn't even matter what this is for. It could be for grandkids' tuition. It could be for medical bills. It could be a new car. It could be literally anything. The point is, this is his immediate cash need that he needs, which means he doesn't need 450. He wants 450. He needs 50 grand. And so Seth is going to say, hey, this is not a problem, right? What if I can show you a way to give you the $50,000 tax-free? And what you're going to do is you're going to take the rest of that over time. Now, again, we want to serve the sellers the best that we can. So we got to ask questions like, is there anything else that's important to you, Mr. Seller, Mrs. Seller, whoever it is? In this case, look, the seller was already in their 70s. A 30-year mortgage is not something that is that attractive to somebody in their 70s. And so he said, I'm fine with all of this, but let's try to wrap it up in like 10 years. And so Seth says, cool, not a problem. Why don't we do that? So Seth now has 10 years to refinance it, pay it off, or sell it. Not a problem. We're going to explain why that's not an issue. Now, for everybody panicking right now on this $50,000 down, here's what you got to understand. There's two options. Seth, typically he would have to have $50,000 in order to do this. But you know what Seth has as an advantage as a note school student that most people don't? Note school has a vendor who will put 100% of that money up for him. Now, why would they do that? Because you got to understand, here's what I'm going to get to. Seth only needs that $50,000 for about 30 to 60 days. And I'll really explain what that looks like in a minute. But if Seth had $50,000, which actually in this case, he did have $50,000, and the only reason he would put up his own money is because it's going to come back in 30 to 60 days. But really, he could use a vendor of ours that would be willing to put this money up. And why would a vendor just randomly put up $50,000 for some guy that learned creative financing from Eddie Speed? Where's the protection? He's loaning $50,000 on a $450,000 asset in a first position lien. Now, we don't have time to get into that today, but we're going to explain how you can really make this smaller guy, the $50,000 guy, why you can make him first position and why it's not going to be long-term. Okay. The bottom line is the seller not only gets the price that he wants, he really gets the money he needs and wants today. And we're going to show him how he can do it tax-free. And the rest of the money comes tomorrow. And tomorrow we have to really kind of figure out what's most important to you. It's the same conversation over again. Instead of money now, it's about the money later, right? And so we're going to talk about that. And in this case, now that Seth has a property, right, and now Seth has, the financing to go with it, what can he do? He can sell it, he can rent it, he can, flip it, I guess, wholesale it, maybe in theory. I don't really know how, but you get the idea. He's going to choose to turn around and resell this thing to a penalty box buyer. And the reason is because you can actually charge a premium because you're offering a service, right? You're saying, hey, I'm going to sell houses and I'm going to offer financing. And so Seth said, I want $475 for the property. I'm looking for $75,000 down and you'll owe me $400,000. Why would Seth do that? Well, the premium is that's kind of obvious. You want more money, but two, he was asking for $75,000 down because he wanted his $50,000 back or to repay the vendor, right? And Seth also has some money today goals, right? He's got a company, he needs money today. And he wanted to put 25 grand in his pocket. So this is what he was shooting for. And he had 3 to 5 buyers to pick from that all met this criteria. It came down to Seth's preferences after this, right? So now Seth's making some money today. He was able to get a payment at $2,661 coming in from the buyer. He had already negotiated a payment of $1,111 with the seller. To give you a little bit of understanding of these numbers, he got the seller to agree to 0% interest. And a lot of you aren't going to believe that's a thing, but I'm telling you, when I say you can get terms from a seller that you can't get from a bank, this is what I'm talking about. You just have to learn how to present this in a logical, rational way, right? Stop trying to be slick and salesy. Whereas your penalty box buyer, on their hand, yes, they're paying a higher price, they're paying a higher interest. The non-qualified mortgage borrower, which is somebody who can't get a mortgage at a bank, pays somewhere between 6 and 10% interest. That's the market rates right now. And so that generates $1,500 a month in cash flow for Seth. That's the cash flow, which would probably be a little bit more than the rent payment, right? But you get the idea. And the other thing people don't realize is the borrower himself has 10 years. He's going to assume the same position that Seth was in. You have 10 years to either refinance, pay it off, or sell the asset. And the cool part is Seth's going to help him do it. But let's just assume he goes all the way to 10 years. It hasn't been 10 years yet. In 10 years, because he paid 7% interest on this thing, he's going to owe $343,000, right? His mortgage will have paid down. Seth didn't pay any interest, so his mortgage paid down faster. He owes less. But Seth gets the difference. He literally gets a bonus check of 76 grand, literally for doing nothing but waiting for 10 years. And when Seth does these deals, not only is he getting more of them because of how he's presenting them, he's obviously setting these big paydays out in the future. And this is really what that ends up looking like is he made some money today, right? Because that's important to us for who are transactional. We've got I've got overhead. My kids, they still eat snacks every day. I still got to have money for that, right? I can't just focus on my retirement. He's going to get cash flow moving forward, and then he's going to get a bonus check. This thing goes all the way to 10 years. The point is he's going to make a lot of money doing a deal and paying retail. The point is not about the money, right? Don't get hung up in the fact that, oh, holy cow, big shiny number, right? Here's really what I'd really prefer you focus on. Number one is simply that he paid retail. Do you know any sellers who want a retail price right now? Yeah, cool. I figured. So is there a way you can say you can have that part? What else is most important? Well, I need X number of dollars for whatever. Okay, great. If I can give that to you, would it be beneficial? Sure. If I can show you how it could be tax-free, would that be beneficial? Absolutely. Right? I mean, obviously it's potentially tax-free. You've got to ask some questions to really make sure you understand a little bit of their scenario. And then you're going to tell them, hey, go ask an accountant. Tell me if I'm wrong. Right? But really the biggest thing is, are you missing deals like this? Are you missing deals because somebody wants retail, or are you missing deals because you're trying to get them to agree to terms so they can sell you the property with financing, but you can't quite make it happen, right? The bottom line is this is something that works really well in today's marketplace, and this is a way to approach it that no one else is really approaching it right now, right? And this is simply, I show you this part first because you just watched me create a note in Seth's story. Seth created a note, and now that you know what a note looks like and how it's created, now it's going to make more sense when I talk about the rest of this stuff, okay? So let me kind of fast forward and really talk about the performing loan space, because for some of you are like, look, I don't want to go talk to the seller. I really don't even want to go negotiate all that stuff and find the buyer. That's too active. I just want to buy a note that Seth already did all the work on. Seth's already got the down payment. Seth's already been getting all the payments. He's proving to me that borrower is legit and a good borrower. And I just want to buy that from Seth or somebody like a Seth at a discount and get a high return? Can I just be passive in that way? That's this world right here, okay? And so let me give you a simple example of the note business, right? When we look at a note, we look at the value first. So it doesn't matter, it could be anywhere in the country. Notes is extremely virtual because it's only the paper we care about, right? I just want to be able to see it on my computer screen that way. I don't really care. I don't need to go walk the property or even drive by it, right? So $48,000 in this asset is what it's worth, right? You can get a market valuation from a BPO, from a comps, from an appraisal. There's a million ways you could do it for really cheap. But I need an idea, because that $48,000 is two parts. It's the equity and it's the debt, right? We're buying the debt part, the first position mortgage lien, and the equity tells me my risk, right? So if there's 37 payments they've been paying for 3 years and the property's gone up this much and yada, 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 really helps me better understand really what am I associating my money with? Well, 65% loan to value is pretty good. If anybody in here has ever been a lender, especially a hard money lender, you really want to be loaning money at 65 to 75% loan to value as a max, meaning that if you get completely hosed on the deal, you've still got some margin in there to be able to get your money out, right? The lower the loan to value goes, the lower your risk, right? And the cool part about notes that I really didn't grasp early on is this, right? You can do these things in a tax advantage account, right? Benjamin Franklin said there's two things in life that are certain, it's death and taxes. Benjamin Franklin was unaware that there was going to be some legislation passed that allows us to do things in like a Roth IRA and not have to pay taxes on those, right? Or really, I would say defer the taxes, or depending on the vehicle, right? Or, pay taxes now and then not have to pay taxes later. You get the idea. The point is, I'm going to look at the debt. And I'm going to say, okay, it's got an interest rate, it's $318 a month. And when you're buying a note, that's what you're buying. You're buying the right to receive those future payments. So in this case, if I'm buying the note, I'm buying $318 a month for 203 months, right? That's what I'm hoping to get. And so there's a third party who actually manages all this called a note servicer, right? And really the way that it works is they're going to collect all these payments and they're simply going to send you the check, or your IRA a check, or whoever's buying the deal. And at the end of this deal, you've received all of your money, all of your interest and everything. And the cool part is that not only are you getting paid off, but let me show you something else. I told you a minute ago that notes are bought and sold at a discount. So this note, $31,312 is what is owed on the note. And if I paid $31,312 for the note, that's called the coupon rate. I would be getting a return on investment of 10%. Because that's what the note is written at. But if I buy it at a discount, it changes my risk and it changes my return. So this note was bought in an IRA for $24,425. And the cool part about this is it lowers my risk to 50%. Instead of loan to value, it's my investment into this deal compared to the value. So now I have literally twice as much money to protect whatever money I put into this, 50% investment to value. But also it makes me a 14% return on investment because that equity is just money I'm going to get that goes to my return, right? So this is really what's kind of attractive about notes to me, is not only that I could get a fixed return, but when I was a hard money lender, even though it's short-lived in itself, I was just so active. I was always, okay, we made 14% on that one, but now we got to turn, we got to find another investor who wants to buy another deal. And we're going to take a whole nother risk set on top of that. And we're going to try to go for it. Right. And so ideally for 10 years, I can try to hit those returns, but now I can buy one note deal with one risk associated to it. And now it's 203 months, over 15 years of 14.19% annualized. I mean, who wouldn't be happy with that? Right. And if you're not happy with that, don't worry. I got something for you too. But I think most people are going to look at that and say, it's pretty good. And the longer you're in the note, guess what? The lower your risk goes because you're getting some of your principal. The property in theory might even go up in value. You get the idea. And so this is what's beautiful. Obviously, in a tax advantage account, it's beautiful as well. But for those of you who say, look, Brian, I'm active, I can get some killer returns. 14% is nice, but I don't know, maybe I can do better. Well, I want to introduce something to you. You're going to hear a lot at Note School, but I just get to be the one to introduce it. It's called the concept of partials. And partials are like pizza pies is what Eddie says. If it costs you $6 to make a pizza, how do you make money? Well, you got to go out and you got to sell it for $12. Or if you've ever been to a pizza shop ever, you know you can sell it by the slice, right? And if I sell each slice for $2, by the time I've sold the front half of the pizza, I've got all my money back, but also I'm still in control of the pizza. So if I decide I don't want to sell it because I'm starving and I want to eat, I could eat that and it would be free, right? Or I could, whatever, I could sell it still. I don't know, I could throw it at somebody if I get angry. There's a lot of things. The point is about control, right? And so if you want to make a lot of money in the note business, like a lot of money, especially if you're into building wealth or generational wealth, you have to learn this concept. You have to learn how to buy long, which means buy basically commitment to the entire note. And then you're going to sell short, meaning sell the front section of the pizza, right? Or the front part of the note. So this would be like buying a 30-year mortgage, and then you're going to say, I'm going to go sell 10 years of that up front. It's a pretty weird concept, but this is amazing. One of the best wealth building tools that I've ever seen. Eddie's been doing it for ever since he's been in business, because he learned it from his father-in-law, Mr. Shoemake, who was doing it before Eddie ever even knew what a note was. In fact, there's a very funny joke about when he got into the note business, or the loan business is what he called it at that time. He said, it's just, I was so naive. I thought, being or buying, gosh, now I'm screwing the joke up. The point was, he thought a loan was just being by yourself. That's kind of the joke, right? And so he was a little confused on how all this works. And over time, obviously, we've been able to simplify this and make it really simplistic. So really, what does it look like for this partial concept, and why is it such a great wealth building tool? Well, let me show you. I'm going to go out and I'm going to go buy a note, all 203, all 203 payments of 318. And then I'm going to go to somebody who really wants a extremely passive return on investment. So this could be family, friends, investors. Maybe my IRA buys this and I partner with somebody else who has an IRA. And really the beautiful part is someone says, hey, you're doing really great in the note business. I really want to get into that. I say, cool, you got a couple options. I can wholesale you a note and you can go on and you own the note and you can do whatever you want with it, but you're responsible for it. And if things go wrong, you need to have the knowledge to make sure you're able to manage that. And if that's something they're like, yeah, I know enough about notes, I feel confident doing that. Great. I'd love to be a note provider for you. Or you could say, look, you basically want the upside without the risk, right? Well, don't we all? What if I could show you a different way to approach this? I'll tell you what, instead of you just buying your own note and you being responsible, instead, why don't you just more partner with me, right? Why don't you buy a part of a loan that I already own? And what does that look like? Well, I'm going to buy a note, and I'm going to sell you the front section. And what do you get for that? Well, you're actually going to get the front section of the loan instead of the back, which is more valuable, but you're also going to get all the payments, all the cash flow for that time period. So let's say if it's a 30-year note and I sold you 10 years, you would get the first 10 years of cash flow and all the interest, right? That's one thing. Two, in theory, I'm not going to take any cash flow until really you're paid off. So there's kind of an incentive there, right? But three, if something was to go wrong and you're making money on the front side, I'm making money on the back side. Well, I'm a selfish guy, right? If something was to go wrong when you're in the note, I'm going to step in. I have the knowledge how to handle all this, and I will come over and I'll solve the problem to keep this extremely passive. So instead of taking X% for doing it all yourself, wouldn't you take less percent interest or a lower return if it's lower risk? And in theory, they're going to say, yeah, absolutely, right? So maybe they go from 8% to 7% or whatever it is. Well, I'm going to show you an example here to where, what if they still want 10%? Like, what if I went to my brother and my brother was like, look, man, I really want to do this, but I only want double-digit returns because I'm greedy like that. And I want to be passive and I want low risk. How can you help me get that, Brian? And I'd be like, oh my gosh, Christmas is going to be rough. But then I would say, not a problem, buddy. Here's what we're going to do. I'm going to get you 10% return. You're going to get $318 a month for 120 months. These are literally numbers that I get to pick, right? And again, the way that works is, my brother's name is Craig. I'd say, Craig, you get $318 a month for 10 years. And once that 10 years is up, you received all the money that you put in and all your interest, and you're completely done. And I'll say, hey, do you want to do it again? I'll go buy another note. And they'll say, yes. Then after you're fully done, now is when I start to get these payments, right? And he says, this sounds interesting. I think I'm in as long as you're going to step in if something goes wrong. I said, I'm absolutely going to step in because I got to protect my money. I don't make any of my money until the backside. And so I said, Craig, write me a check for $24,063. How did I get that number? I plugged the other numbers into a financial calculator and magically spits that number out. And so my brother, there's a note servicer who's collecting all these payments, and he's going to say, oh, looks like Brian's brother, or maybe even Brian's brother's IRA, owns the first 10 years of these. And so we're going to pay that entity $318 a month for 10 years until it's completely paid off. And then we'll start to pay Brian or Brian's IRA or whatever. And my brother gets fully taken care of. This is your passive partial investor, and he's done. Now, why in the world would I ever consider giving up 10 years of cash flow? Isn't that what we're taught? We're taught to like keep the cash flow. Isn't that the whole point of this game? Here's something to consider. First of all, this was done in an IRA, and this is one of the reasons why it's such an incredible wealth building tool, is you can do it in a tax advantage account like an IRA, an HSA. Eddie does this in his grandkids' Coverdale education accounts. You get the idea. And the point is this: if my brother buys the first 120 months from me, I get the back 83 months. He's going to put up $24,063, but you got to remember, I bought the entire note for $24,425, which means my brother gets fully taken care of as always, but I only have $362 left in the deal. I got the rest of that money back, so I can go buy another note and possibly sell another partial, right? So my money wasn't out very long. I left $362 of the deal left in it. And what do I get for that? Well, my IRA in this case is going to receive $26,000. So why in the world would I give up a 14% return on investment in the cash flow? Well, because from a wealth building perspective, I could choose to do this note in like an IRA, leave really only $362 in it, get my money back and do it all over again and all over again and all over again. But what's your rate of return if you got 362 in it and you get 26 grand, right? At note school, we just say, if you don't need a calculator, that it's probably enough, right? That's the concept of this whole thing. And this is why the power of this partial concept works so well, is it's extremely flexible. You could leave a lot of money in it. You could leave no money in it. I could take $5,000 out and put it in my pocket, and the rest of it will be for the future, right? It's very moldable. And actually, I'm teaching a one-day class coming up here. And this is really where I have a whole day to go into the details, all of this stuff. So you better understand not just how flexible it is to meet your goals, because depending on what you're trying to accomplish, you might be trying to make money now. You might be just trying to focus on building your wealth for the future. Or you might be like me, where you're like, I need money now because I got a business and I got overhead and I got bills to pay, but I don't want to just do this and give up building my wealth. I want it all. I want both. And so all of these strategies I'm showing you today, they all work for money today or money tomorrow or both. It just depends on what are you trying to do. And let me show you how to mold these deals to accomplish what those goals are. And so the reason I show you those strategies first is eventually now to get to this conversation of really what it looks like to buy a defaulted loan. And again, buying a bad debt. Why in the world? Why would I do that? Why would I buy an asset that's not cash flow? We just talked about that. Aren't we taught to focus on cash flow? Well, here's the deal. This is a market opportunity that, well, it just doesn't come around all the time. It's a part of the market cycle. And everybody can relate to the guy who was buying properties back in 2011, 12, 13. Oh yeah, they were killing it. They were doing incredible. Of course they were. They were buying for super cheap. How did they do that? Well, short sales. What if I told you could get ahead of the short sales? What if I could tell you could go way, way, way back, right? And this is really the concept of bad debt. And just to give you an understanding of why this is such a powerful conversation today, everybody understands there was a bunch of foreclosures in 2008, 2012, right? We get that. What I'm talking about today and why it's so radically different is the moratorium, the foreclosure moratorium. So obviously we've had a year and a half of people not being able to foreclose on people who haven't paid their mortgage. And this is not a good or bad. This is literally just facts. Take it for what you will. But understand that is actually not the biggest variable. There were 5.5 million non-performing loans prior to the pandemic that on average were 2 to 3 years delinquent. So they haven't paid in 2 to 3 years. And now they're supposed to be being foreclosed on. March of 2020 shows up, and these loans, what we've referred to as legacy loans, these loans were told, stop. You can't do anything with these 5.5 million. And whenever we do release all of these things, then you can kind of start that process. What's crazy is the pandemic started with 5.5 million loans in default. How many more people are in that spot? Well, I can tell you the latest data that we've seen is there are over 4.5 million people that are not making a mortgage payment today during the pandemic. Okay, so let's take a look at these. Out of that 4.5 million, 1.2 million of those are in forbearance. Now, forbearance, for those you don't understand, it's just simply like a timeout on your loan, right? It's not forgiveness. You have to pay it back, but they say, look, you can't pay right now. Just in 6 months, you're going to have to start paying again. And ideally, we'll really take a lot of that debt and we'll put it at the end of your loan and we'll get you paying again. But within the next 6 months is really where we start to see a lot of these assets start to hit, default and foreclosure and courthouse steps. We can track that data. How can we track that data? Well, there's several different variables we look at, but one of them is simply the forbearance programs. Did you know that out of these 1.2 million forbearance programs, 300,000 of them completely expired in August? So, okay, great. Now 300,000 people have to figure out what to do. Do I just pay it off? Do I get caught up? Do I move? Do I sell? Or am I going to let them get foreclosed? Do I qualify for a mortgage or like a modification? Like, they have lots of options, but unfortunately they had lots of options in 2008, 2010 as well. But what did we see? Unfortunately, people don't read before they sign things. And what you're going to see is a massive amount of these forbearance, unfortunately, fall into that foreclosure type path and category, right? And there's a big difference here between this market cycle and the last. But one of which, kind of to finish the conversation about forbearance, is out of 1.2 million, 300,000 expired in August. In September, at the end of this month, 700,000 of them expire. So what does that tell you? That tells you that on October 1st, there is an insane amount of pressure that has now entered the market. A ton of these mortgages, a ton of these lenders are forced to figure out, what are we going to do? We kind of got to figure something out, right? What's different about this market cycle than last time, and one of the things I love about this, is that loans compared to the value, the equity has been building for 10 years. And especially, everybody knows houses have gone up in value in the last year or so, right? But really, they're kind of at an advantage. And so you can buy this bad debt, and the likelihood of you getting the house is maybe a little lower. You could look at it like that. But more importantly, they have a lot more options, which means you get paid off faster. And if you get paid off faster, if you know anything about the time value of money, you can circulate money faster, which allows you to do more deals, which allows you to make more money. You got it? And so this is really one of the biggest variables in today's marketplace, and why people here like Note School are so excited about it is I can raise capital, and I could take that capital, instead of saying I need it for the next 2 to 3 years, I could say I need it for 12 months to 18 months, and I'm going to turn it twice in that time frame. So I'll double my amount of money in half the amount of time. And Eddie Speed will tell you, if you're wanting to double your net worth over the next 2 to 3 years, you just have to wait until a non-performing market cycle appears. And he's been saying that for years. Well, guess what? As far as April 1st, 2020 occurred, it became a holy cow, there's going to be a market. The question is when. And we've literally been tracking it. And this summer, they finally released a lot of these legacy loans, and we started buying them. And to give you a better understanding, I'm going to go through a couple of their slides, and I'll tell you about how they look today versus in the past. And so really, when we're talking about this non-performing loan space, I'm talking about, instead of fixing and flipping an ugly house, you're essentially fixing and flipping an ugly mortgage, right? A mortgage that isn't paying is just troubled in some way, right? And we have to bring that creative solution to rehab it, so to speak, right? And by doing that, we'll either get them repaying, or we'll end up with the house, and that house we can go do what? We can wholesale it, we can list it, we could flip it, we could rent it, we could sell it as a turnkey rental, we could sell it to a penalty box buyer. And if we did that, then we would have a note, which then we do? Well, then I could sell the note, or I could sell a partial of the note. My point is, your flexibility is enormous when it comes to non-performing notes. And the other variable that you got to understand, outside of if you can fix and flip something ugly that's a house, you can do the same thing with the paper side of real estate, is this. If this is really working for you right now, like right now, if you're buying houses at 70 cents on the dollar, you're wholesaling it, flipping it, renting it, whatever, and these numbers work for you, keep doing it. Don't stop. But what I am going to tell you is, based on market conditions, if I could say, look, why don't you deploy some money into the non-performing world at 35 cents to 55 cents on the dollar? And this is really going to allow you to where the worst case scenario is either a cash flowing asset, or you get a house worth, 3 times or half as much, or twice as much. Now you're getting into it, instead of 70 cents on the dollar, you're at 50 cents on the dollar, or whatever the magic number is, right? And so as this kind of unfolds, you'll start to see more and more details. and more deals kind of appear. The problem is people don't know how to access non-performing loans. And that's why I teach a whole class on this whole business, is solely because I need you to better understand what they look like, how to structure them, where to actually go get them and what to do with them once you got them, right? So there was a note I bought in Missouri. I live in the Denver, Colorado area now. And there was a note I just bought, one of these legacy loans in Bloomsdale, Missouri is the town. And the reason I bought it is because I thought, oh, cool, this one's going to go to auction next week. So it was a Thursday, and it was $80,000 was the non-performing loan. That's what I could buy it at. The house is worth $240,000. So here's the question. How many assets are you buying at 33 cents on the dollar? Because I'm going to assume it's not a ton. But here's the other thing. By paying $80,000, right? They missed some payments and they owed some fees and this kind of stuff. But really, they had only owed about $102,000. So I bought it on a Thursday. I funded it on a Friday. It went to an auction on a Monday. And if it happened to sell at that courthouse steps, what would have happened? Well, on Tuesday, Wednesday, or Thursday, I would have been paid $102,000, which means I would have made 20 grand in less than a week, all because I saw the opportunity and I saw the gap and I saw the upside of, if it doesn't sell, what happens? Well, chances are I'm going to end up with the property. What ended up happening is not only did it not sell at auction, the borrower decided to file for bankruptcy for whatever reason. And I'll be real honest, I don't know much about bankruptcy, and I don't have to know much about bankruptcy. The people who need to learn it is the note servicer who's managing all this for me. And the cool part is I got an email from my note servicer that says, hey, the borrower filed bankruptcy, and they're just going to walk. In order to basically pay off all their debts, they're just going to give away their assets. And for me, being the first position lien holder on the house, guess what? All I got to do is file some paperwork, and guess what I get? That's right. I got a $240,000 asset that I could probably fire sale at $180,000 if I want my money quickly, which I probably do, because there's just more assets to buy right now. So I can more than double my money in whatever, even if it took 6 months. I'm just saying, like, the opportunity with non-performing notes that I didn't understand was that when the opportunity presents itself, you just need to be knowledgeable on what to do with them, where to buy them, and go to town. And you already have the knowledge on, if you get the house, you could wholesale it, you could rent it, you can go back to your normal strategy, right? And so this is a great way to either diversify or whatever else. But once you understand the note business, kind of what I explained today, how I know to create it, and once you have a note, what you can do with it, you have so much flexibility, not just because your risk is lower, right? If you bought something at 40 cents on the dollar, you understand your risk is lower, but you're also protected in that you're either going to get paid off whatever you're owed, which is a number higher than what you paid, or you're going to get an asset, right? And so it's just a very interesting thing to kind of consider. And if you're wanting to learn a little bit more, whether it's about really, how do I talk to sellers about, this tax strategy, or how do I create my own notes, or how do I wholesale them? You just got to take a next step. And here's what I'm going to encourage you to do is I'm going to basically encourage everybody here. The best next step for you is the same step that I took. Trust me, I went on the exact same journey I'm going to send you on, right? It's really go out and try to find a way to educate yourself a little bit longer. And in this case, what we're talking about is really this class we teach called Golden Notes. When Eddie brought me onto the teaching team, I was talking about maybe a handful of things. Now I'm teaching this whole class, since I'll just be honest, right? I probably have sat in front of I can actually assure you, I've sat at a kitchen table a lot more recently than Eddie has, right? It's not good or bad. I'm just saying that I really feel like the reason Eddie has asked me to teach this class is solely because I'm relating a little bit more to really a lot more investors right now, right? And Eddie's trained 300 of the top 500 real estate investors in the country. So it's not that this only works for new people or experienced people, it's across the board. But this class right here, it's a full day class. We really use case studies to break down the details so you can really see the whole story, right? We found that this is kind of the best way to do it. We talk a lot about this logical, rational conversation. How do we use logic and reason to show the seller, hey, seller financing is going to be in your best interest? And now we're adding in the conversation of, what if there was a tax advantage to seller financing? What if I could show you that you could pay less taxes? I could give you a bunch of money right now, tax-free, AKA it's not going to be my money, right? but it's going to be a vendor's money that will give you that vendor, right? The cool part is we can go out and acquire more houses if that's what we want. And if I get those houses, I now have more exit options. Right? I could obviously find a penalty box buyer. We didn't even get a chance to talk about that today, but that is the nut. I mean, this was $1 trillion marketplace of buyers prior to the pandemic. We don't even know the real numbers now, but there are 35% less qualified borrowers today than there were before the pandemic. That's how many people we're talking about. They have massive down payments. I got the data to show you, and they typically have pretty good credit scores, right? As in, like, well over more than like a 620 credit score is typically fine to get a mortgage. And we're talking about borrowers that have more than 620. So if you can get a borrower with more than 620 credit score and they're willing to give you $50,000 down or whatever it is, 30% down, 20% down, I mean, it's just gangbusters, right? And so we're going to talk about how to use IRAs like a bank, really to be able to structure these in a tax advantage or tax-free way. We're going to talk about wholesaling notes if you're looking for money right now. Obviously, performing notes, partials, we really get into non-performing loans, really how to make a lot of money from bad debts, because that's what the market opportunity is right now, right? And just for attending the class, we're giving away 2 books, right? Eddie wrote this book right here, Moneyball 2. This is all about this creative financing world during and after a pandemic. So this will actually equip you with some resources about how creative financing is different today than it was 2 years ago, 10 years ago, and 40 years ago, right? And the red book is Making Money from the Post Meltdown. This is all about the non-performing note business, obviously. And then we just have more time to dig into all of these niches. You get the idea. And so I tell you that to really sum it up with one thing that I'm referring to as my passion project, which is one of my biggest reasons I love to teach this one-day class, is because this radically shifted kind of my view on wealth. And there's a lot of people here who really focus on money today. And if there's somebody who can relate to that, it's me, right? When I'm the only income earner and I got a pregnant wife and all this stuff, like, I need the money. And to this day, even though we have a completely different lifestyle, trust me, I got overhead. Employees, turns out they like to get paid every 2 weeks. It's almost like clockwork, right? I can't just stop making money today if I want the machine to keep running. And so I need money today. The difference now between 5-6 years ago is I used to just focus on money today because I didn't have the capital to deploy and just let it go for the future. And so if you're somebody who's money today, please listen to this next 30 seconds. Because if you take one thing away, I hope it's this. Come on Saturday to learn this one strategy. I'm going to show you how to take a $100 bill and turn it to $100,000 absolutely tax-free from one note deal. And the concept really behind this is I'm going to show you how to do one note deal in a self-directed retirement account to where you can set it and forget it. Because literally it's just going to be managed by a no servicer. You're not really doing anything. It's very passive. Once somebody's been paying for 6 years, and if they paid all throughout the pandemic, they're probably going to keep paying. I don't know what else would happen in their life. So you set it and forget it. And now you can get back to that active lifestyle, that active income you're trying to accomplish. This is the thing that I just wish I knew. Instead of having $20,000 and $30,000 to put down on a rental property, I just wish somebody would say, look, put $100 into it. Because if I can show you how to turn $100 into $100,000, don't you think we could then take that $100,000 and turn it into, I don't know, more than $100,000? I think you get the idea. This is really where I'm like, the way I view note school is like the Harvard of the note business, right? And a lot of times I think they're like the Harvard of like the real estate investing world, right? Because they take these concepts to such an extreme. And this is all the stuff that we're really wanting, but we just can't quite figure out, how am I supposed to go and actually do that? Well, if you come on this Saturday, September 18th, it's a full day class, and it's really built to be very interactive. So bring your questions, bring your comments, bring your business problems. Let's really try to figure out how these different variables and these different strategies and these concepts that he's talking about, how do these fit into your business today? Because one thing I love about Eddie is Eddie's not the guy who says, stop doing your thing and do my new thing. He says, look, I can equip you with plenty of tools to make you better at what you currently do. That's what it looks like to be a deal architect. And I could show you even more ways to scale that and grow that, because you're going to have more opportunity once you've done that work, right? And so it's a $97 class, literally just to attend, ask your questions, come get involved, get the books. It's going to be a great time. A couple of bonuses is this. Here's how you sign up, by the way, and then I'll talk about the bonuses. You got to go to noteschool.com/SJREI, right? That link right there, you can register right there. It'll kick you back the webinar links for the class, the whole thing. But two things are going to happen. for those of you who are interested in this. First of all, for those of you who stayed to the end, you're rock stars, you're amazing. Lori's going to literally give away her latest book for free just because you hung out here. So that's cool. But before I hand it back to Lori, here's what we're going to do. If you have a business partner, right? Or maybe it's a family member because you're all about building legacy wealth. If you want that person to attend without having to pay the $97, you can write Lori a thank you note. You can buy her coffee next week or something like that, because she says that she will offset that cost. And so if you're somebody who says, hey, I really want to do this, I don't know that I want to spend $200 for my business partner to do it because we're in different houses, obviously. It's a virtual class. Here's what you got to do. Get signed up today and then send me an email. I'm going to give you my email address here in a second. Send me an email saying, hey, I signed up. My business partner's name and email address is this. Please register them. And I will go and manually register them for free. And that's, again, thanks to Lori. So Lori, you got a lot of coffee coming your way. So just be ready for that. You know what I mean? Expect the gift cards.
Awesome. Awesome. Looking forward to it.
Yeah. So that's pretty much it for me. I mean, I'm happy to do some Q&A and really make sure I'm answering some questions. And we'll kind of keep it going from there. However, and I need to give you my email address. You're right. So here's my email address. Everybody write it down, or we can type it in the chat. It's Brian, BRIAN, @noteschool.com. So your steps would be to go to the link you see on the screen, noteschool.com/SJREI, get registered, and then send me your information and your partner's information, and I'll get your partner registered absolutely free. So thanks so much for having me and letting me kind of, share this. I love talking about this kind of stuff. So let me know, what kind of questions do we got?
So Brian, that was amazing. And I have to tell you, it's like so many nuggets in there. I hope people were paying attention. I know I was taking notes. So awesome. All right. So I think, Jeff, there was a couple questions in there. I don't know if you have those. Jeff, are you able to hear us?
I can hear you. So yeah, there was a question from Steve. If they've been paying for 6 years, isn't there a possibility there might be a refinance the loan? And if you are partway through a 10-year partial and expecting you to take on the back end, then what happens if they refinance it anyway after 6 years? So did you get that, Brian?
Yeah, I did. And this is a pretty common question. I got a bunch of examples. I'll even show you a spreadsheet I use to make this super easy, because especially if you're like selling a partial, they're going to ask the exact same question. So there's two things. First of all, if they're 6 years in, is there a possibility that they might refinance the loan? Absolutely. Of course there is. That's actually what makes this advantageous, right? If you could buy a loan that has 20 years left or whatever, and there's, they've been paying for 6 to 10 years, and you buy it today and they refinance in 2 months and you get paid off all at once, why would that be a bad thing? Now you're getting money faster. But if, let's just say they're partway through a 10-year partial and you're expecting the back end, and all of a sudden, oh my gosh, there's this refinance and you haven't gotten any payments, and your partial investors being passive, but they're not actually out of the deal yet. What happens? Well, they got payments for 6 years and then there's a payoff. So let's say there was a $100,000 loan, and in 6 years, $95,000 is what's owed. Well, you don't get all $95,000 paid off if you sold this much of the partial, right? So out of that $95,000, let's say your partial investors owed $30,000 of that. Great, they get $30,000 and you get the rest. And so you'll see why this is so flexible. And on Saturday, I really show you so many examples just to help you better understand every one of these scenarios, right? Because they're all very similar common questions. And then you take a spreadsheet and you send it to these people to say, look, run all the hypotheticals you want. The bottom line is, when things shift and when things go bad for the bank typically doesn't lose. That's the general rule of thumb. And you can use math to show it too. So hopefully that kind of makes sense.
That's great. Others have questions? This is an opportunity to ask. You can either open your mic or you can type in the chat. So Brian, what are you seeing in the marketplace as far as the typical length of notes that are being created?
So this is what's really funny. I took a poll on this last year because I started thinking I was crazy because I kept seeing all these 10-year notes. And I was like, who's creating all these 10-year notes? What is going on? It's like, are buyers just not saying yes to longer? Or, I mean, is there some magic class I missed or whatever? And literally what I found out was like, I don't know, some real estate investor somewhere said, oh yeah, I'm crushing it with 10-year notes, I'm guessing. And everybody else just started saying, I guess the seller will only say yes to 10 years. And so it's really not the case. I actually have found even, and I'll throw myself under the bus here, that even with 10 years, I find myself in this position. I feel awkward asking for too long. And it really kind of took me a while to gain the confidence of like, why would I not ask for 30 years? Again, I'm mathematically showing them that the longer this goes on, the better they do. So I just had to build up the confidence to ask for longer. I don't know how I got it in my head or who came up with the idea, but you can pretty much do a note for most lengths of time. There are some guidelines if you're creating a note. You don't want to create it too short. It needs to be around 8 or 10 years, according to Dodd-Frank compliance things, or longer, right? And those are some things you want to take into consideration. But when you're creating a note, whoever's really facilitating your closing, whether it's a title state or you're talking to an attorney, trust me, they're going to be letting you know. Where you're like, yeah, I created this 3-year note. They're going to be like, no, we're not doing this. This is not favorable for anybody. So yeah, that's
Awesome.
pretty much what I'm seeing. And also we actually have we built a case study of seller finance notes that I'm going to show actually in the middle of the one-day class, where we took on 687 sellers who had notes. And we said, what's the average interest rates? How many took no money down? How many took a down payment? And really what's crazy is the average seller, they don't ask high interest. Most of them do not want an extreme down payment. And what didn't click then and has now made sense is, again, they weren't telling me they didn't want to have to pay taxes. They didn't want to, if I give them 100 grand down, they're like, oh gosh, now I got to pay taxes on this, is what they're thinking. And I didn't put the two things together, so.
Yeah, so I mean, and that's true. We just bought a duplex. They were willing to let us get into it with $25,000 down on an $850,000 note. So, we now have an 825 note and our interest rate's 4%. We just wrote another one at 3%, interest only payments. And then I think both of them, well, one of them was 10 years with, I think, another 10-year renewal. And one was maybe 15 years. And it was because, like you said, the people are in their 70s, early 80s, and they're like, we just want it to go long enough to to be money for us to live on.
Yeah, absolutely. And the crazy part is statistically in the 90% chances, if you're in a note between 8 and 12 years, if it goes longer than that, you're at an over 90% chance of refinance right after that period. So really, if you wrote a 15-year note, the chances of it refinancing or paying off or something are so high, it's not gonna go to term, right? It's such a low percentage chance that somebody's actually going to be in it for 30 years. It really just, it matters more on how are you meeting the seller's goal. And the other cool thing too, is you still amortize it over 30 years to get that payment down. You're just going to say, look, I'm going to have you all paid off in X number of years, so.
Now, there was one question about using 0% interest, and how is that, how does the IRS look at that?
Let me see if I can find it really quick. So there's an IRS clause that says a portion of the installment sale payments must be counted as interest. So 0% is what buyer or seller agreed to, but not what the IRS would say if they audit the seller. Yeah, this is an interesting take. So this is where I'm like, you'll never hear me say I'm a financial expert or a tax expert, but the key words you want to ask your accountant about are the tax basis, right? And if they say, look, yeah, there's a tax basis, but if you write it at 0%, they're definitely going to tax a portion of that. Here's the solution, my friends. Would 1% interest make this go away? Would 1% interest cause them to not have to pay taxes? Because if it would, I'll pay 1% interest to help the seller. You know what I mean? So I'm not saying that is the solution, but I know there are these little clauses. As over the last month or two, as I've gotten more and more feedback from accountants and CPAs and attorneys and stuff, just through Eddie's team, it's been like, okay, so there are these little hiccups here and there, what's the solution? Oh, that's right. Either pay interest or whatever else. And so definitely make sure you're asking about that when you're putting together these deals, because especially with installment loans, because they've been doing them so long, this is not like a scenario to where like, oh, this is all so new. You know, the law is very unclear on this. Like it's very clear from what I've been told. It's just a matter of making sure, however you structure the deal, are we making sure we're crossing all the T's and dotting all the I's, and there's plenty of help for that.
Yeah, it's been out there since like 1913, so it's around for a while.
Wow.
So yeah. Okay, any other questions? If not, I want to encourage you to sign up at the noteschool.com/SJREI. And again, we're going to allow you to do 2 for 1. So bring a family member or a business partner. So once you register, email Brian. His email is in there, brian@noteschool.com. And that's Brian with an I. And let him know the name and email address of the attendee, and he will get them manually registered for that. So that's just something I kind of did a last minute, hey, Brian, will you do this for my group and for those who are watching? And he graciously accepted to take on that effort. And I just want to tell you guys that I appreciate you staying here till the end. And I had mentioned earlier that there would be a free gift for my book. So that's easy to get to. You're just going to go out to the sjrei.org website, and it's going to be sjrei.org/gift. And you can download my newest book. It's called Influencers Impact. And it talks about how you can impact the people and lives around you by being an influencer and how you influence them. So Brian, any last words before we close out tonight?
I don't think so. I did see a quick comment at the top that I'll go ahead and answer this briefly, but it said, I found that this is mostly the issue of trust. People are not familiar with these strategies, and it sounds good to them, but they doubt you're going to do what you say. And this is so much of what I talk about on Saturday. And really that shift of what I was saying, you don't have to be slick and salesy. You don't have to say like, well, I could do this, but you got to sell their finance. That's not a very attractive way to do it. This is where I'm saying, be the guide, help them understand. You don't have to even have all the answers. You can say, look, don't trust me. Don't take my word for it. Go look into it yourself. You're the only one offering to help them at that point. That is what builds trust. That's bringing true creative solutions to their complicated problems. And that also exposes a lot of the stuff they're not telling you. Now, all of a sudden, they feel free to tell you that. So I always say it's the approach of go out and help somebody. And right now, the easiest way to do it is just equip them with resources. And that for whatever reason, weeds out the competition. I don't have to compete on price and all that. So come on Sunday and come on Saturday, sorry. And it'll be just like church. You're just gonna
keep going till Sunday, right? No.
That's right. That's right. I'll still be preaching notes, but no, on Saturday, we go into it quite a bit, because the psychology of this is a big part of it. If you could understand psychologically, why would they say yes or no to something, it becomes a lot easier just to say the right thing, right?
Absolutely. Absolutely. This stuff works. I love it. Brian, thank you for your time tonight, and we will see you on Saturday, and we look forward to seeing all of you on Saturday too. Take care.
See ya.
Bye-bye.
Bye-bye.